All right, today we're diving into a really fascinating quarter from Cenovus Energy. On the surface, it looks like a story of record-breaking performance and some seriously big strategic moves. But, as you'll see, the real story here is just a little more complicated than that. And this is where things get interesting. When the final numbers for the quarter dropped, they raised a huge question. Cenovus absolutely crushed Wall Street's profit expectations, but they actually missed on revenue. So how in the world do you manage to make more profit while bringing in less money than expected? Well, that is the exact puzzle we are going to solve today. Okay, let's get right into it. A huge piece of that puzzle starts with this number right here, 918,000 barrels of oil equivalent per day. That's not just a big number, it was an all-time company record. It's pretty straightforward, really. They were pumping more oil and gas out of the ground than ever before, and that volume helped supercharge those profits. Now, hitting a record like that wasn't some happy accident. Nope, it was the direct result of a massive company-wide focus on operational excellence. Basically, running every single part of their business, from the oil fields to the refineries, as efficiently as humanly possible. That incredible efficiency is the secret sauce to how they boosted profits, even when total revenue was a little soft. And you don't have to take my word for it. The CEO, John McKenzie, put it best himself. He said, the performance really comes down to having great people and great assets. They set this incredibly ambitious agenda for the year, and, well, the team just flat out delivered. So, to really get how they pull this off, we need to pop the hood and look at the engine. Cenovus really has two main parts to its business, and the key thing to know about this quarter is that both of them were absolutely firing on all cylinders. Here's a super simple way to think about it. You've got upstream and downstream. Upstream is all about getting the raw ingredients, the crude oil and natural gas, out of the ground. Then you have downstream, which is kind of like the bakery. That's where they take that raw crude and bake it into the finished products we all use, like gasoline and diesel fuel. So on the upstream side, the ingredient gathering, they weren't just pumping out record volumes. They also got a brand new project up and running ahead of schedule, and they found clever ways to make their older operations run more efficiently for longer. But here's the real kicker. They managed to do all of that while cutting their day-to-day operating costs by about 4%. I mean, think about that. More product for less cost. That's a winning formula. And at the same time, the downstream bakery was running red hot. Their refineries were running at a staggering 95% of their total capacity. Get this, their Canadian refineries were actually running above 100% capacity. That means they were squeezing every last drop of potential profit out of the market. And just like the upstream guys, they were doing it while slashing costs. But 2025 wasn't just about running things well. That was only half the story. Cenovus also made some massive chess moves, executing two huge transactions that completely reshaped the company for years to come. Okay, so first, they streamlined the refinery business by selling off their stake in a joint venture. Then, just a few months later, they made an even bigger splash, buying one of their key competitors, MEG Energy. This one deal was a game changer, adding over 100,000 barrels of high-quality production per day. It was like bolting on a whole new factory right next door. And the entire reason for a huge move like buying MEG boils down to this one powerful word, synergy. It's that classic business idea that 1 + 1 can actually equal 3. By combining two companies, you can cut out redundant costs and operate more efficiently, creating value that literally didn't exist before. And this wasn't just some vague hope for Cenovus. They have a very clear step-by-step plan to make these synergies a reality. They've already found about $120 million in corporate savings just from things like combining head offices. And now they're targeting hundreds of millions more from making their operations work better together over the next few years. Of course, you can't just go out and buy an entire company for free. These big, bold moves came with a pretty hefty price tag. And that means one thing for the balance sheet: more debt. So, when all the dust settled from these deals, the company's net debt had jumped up to a new total of approximately 8.3 billion Canadian dollars. And this chart really puts that number into perspective, right? You can see just how much debt the MEG deal added. It was a significant jump, no doubt about it. So, why does this matter so much to investors? Because Cenovus immediately came out with a crystal clear plan. Their ultimate goal is to get that debt all the way down to $4 billion. In the meantime, they're going to balance their priorities, paying down debt and rewarding shareholders.
They even set a specific trigger, a line in the sand. Once that debt level hits $6 billion, a whopping 75% of all their extra cash will go straight back to shareholders. It's a really transparent roadmap. So, with their operations running beautifully and a solid financial plan in place, the focus now pivots to the future. So, what's next? Well, let's look at the major projects that are going to fuel the company's next big phase of growth. And that growth pipeline is absolutely packed. We're talking about huge projects, like starting up the massive West White Rose oil platform out in the Atlantic. They've also locked in new gas sales contracts with China that are going to add almost $2 billion in free cash. And of course, there's the ongoing work of squeezing every last bit of synergy out of the MEG deal and boosting production at another one of their key sites. And all of that brings us to the big, lingering question. Cenovus is now bigger, more efficient, and producing more oil and gas than at any point in its history. But can it successfully juggle that new, higher debt load while also delivering on all these massive, ambitious projects for the future? That is the balancing act everyone will be watching.